Hey everyone, it is Julie here with TipRanks. Today we're taking a look at 3 growth stocks that may still be undervalued. Now these are 3 stocks that have seen great growth this past year, but come with buy ratings from analysts that indicate there's still some potential for solid growth ahead. So in today's video, we're going to take a closer look at what it is each of these companies do and what has analysts feeling bullish about their future. Now, please keep in mind that these videos are never a suggestion to buy or sell any specific stock and are just meant for information and entertainment purposes. Any investment decision does need to be made based on your own research and due diligence. With that being said, let's get right into these 3 growth stocks, starting off with Crocs. Trading under the ticker CROX, they're currently priced at $108.45 per share. Crocs, of course, are known for their big, bright, funky foam clogs. And they say that they are the most delightfully comfortable shoes in the world. They believe that comfort is the key to happiness, and their legendary Crocs comfort makes the world a happier place, one pair of shoes at a time. It was nearly 20 years ago in 2002 that they introduced the world to one of the most unique brands that anyone had ever seen. They were different and it made some people uncomfortable. Now, hundreds of millions of shoes later, they make the world comfortable. They've sold over 600 million shoes around the world in over 90 countries. And their $1 billion in annual sales makes Crocs one of the world's 10 largest non-athletic footwear brands. Their most recent earnings was for Q1 of 2021, and they achieved their 3rd consecutive quarter of record revenue, with revenue of $460 million, which was up 64% versus the previous year, with growth in every channel. They had digital growth of 75% to represent 32% of revenue with increases in every region, and adjusted operating profit increased approximately $100 million to $126 million. Their adjusted earnings per share came in at $1.49, which was up from just 22 cents. For the second quarter of 2021, they're expecting revenue growth between 60 and 70%, and for the fiscal year of 2021, 40 to 50% revenue growth. One analyst covering the Crocs stock is Erin Murphy from Piper Sandler. She says, "We applaud the Crocs team for their continued execution, disciplined inventory management, and account management and underlying reinvestments in the brand health. 2, with strong visibility into Q2 and second half estimates moving up handedly with solid order book plans to boot, we believe bears worried about the sustainability of the brand momentum will need to hibernate for another 12 months. The Crocs stock has 8 current analyst ratings altogether, and it comes in as a strong buy based on 6 buy ratings and 2 holds. The average price target of $123 would be a 14% growth potential. Looking at our detailed list of analyst forecasts, all of those price targets were reiterated a couple weeks ago following their earnings report. Our lowest is a hold rating with a downside of about 1%, and we have several ranging over $130 per share, which would be a 20 to 29% upside potential. The second company on our list today is Cleveland-Cliffs Incorporated. They trade under the ticker CLF and are currently priced at $21.96 per share. Founded in 1847, Cleveland-Cliffs has been traditionally recognized as the largest and oldest independent iron ore mining company in the United States. In 2020, Cleveland-Cliffs conducted an enormous transformation that will keep the company thriving for the next century with the acquisition of 2 prominent steel companies in the United States. Today, Cleveland-Cliffs is the largest flat-rolled steel company and the largest iron ore pellet producer in North America. The company is vertically integrated from mining through iron making, steel making, rolling, finishing, and downstream with hot and cold stamping of steel parts and components. AK Steel was acquired in March of 2020, and it was the company's initial entry into high-end steel making. With a U.S.-centric strategy, the investment in AK Steel was a perfect fit and aligned with the company's positive future outlook for automotive production and manufacturing in the United States. The second and final step of Cleveland-Cliffs' transformation into a fully integrated high-value steel enterprise was completed with its acquisition of ArcelorMittal USA in December of 2020. This acquisition positions Cleveland-Cliffs more competitively in an increasingly quality-focused marketplace and amplifies its position in the discerning automotive steel marketplace, further improving its position in important U.S. markets such as construction, appliances, infrastructure, machinery, and equipment. Near the end of April, they released their Q1 of 2021 earnings report. Their first quarter Q1 consolidated revenues were $4 billion, compared to the prior year's first quarter revenues of $359 million. They also recorded net income of $41 million, or 7 cents per diluted share. In the prior year first quarter, they recorded a net loss of $52 million, or 18 cents per diluted share. And their first quarter adjusted EBITDA was $513 million, compared to just $23 million in the first quarter of 2020. One analyst covering the Cleveland-Cliffs stock is Lucas Pipes from B. Riley Financial. He recently raised his price target to $33 from $24, saying that should China pursue its carbon emission initiatives aggressively and reduce exports of carbon-intensive products such as steel and aluminum, Cleveland-Cliffs processing margins could potentially enjoy a multi-year tailwind. With near-term cash flows expected to be robust, with $2.3 billion expected for 2021, the company expects to use excess cash flow to aggressively reduce debt. We see low leverage as a strategic priority for the company at this time, as it proves out the benefits of its fully integrated model. In our opinion, Cleveland-Cliffs represents the most attractive value in the space. Currently, the stock has 6 analyst ratings, and it comes in as a moderate buy, split between 3 buys and 3 holds. The average price target of $25 would be a 15% upside potential. Now, we do have 1 hold rating from 3 weeks ago with a downside of 12%, but our highest rating does come from Lucas Pipes with a $33 price target, which would be a 50% growth potential for this next year. And third on our list today of growth companies is Atlas Air. Trading under the ticker AAWW, they're currently just shy of $75 per share. Atlas operates as a cargo airline and passenger charter service and an aircraft lessor to other airlines, renting out planes along with air and ground crew services. Atlas Air Worldwide is a holding company with 2 wholly owned operating subsidiaries, Atlas Air and Southern Air. They are the leading global provider of outsourced aircraft and aviation operating services and have the world's largest fleet of 747 freighters, as well as providing customers a broad array of Boeing 747, 777, 767, and 737 aircraft for domestic, regional, and international cargo and passenger operations. They service a wide variety of industries, from e-commerce to perishables, apparel, and automotive, and boast a diversified customer base with long-term profitable relationships. They are a shipper for Amazon and different express shippers like DHL and FedEx Express and UPS, as well as a variety of sports charters. Now, just last week on May 5th, they came out with their first quarter 2021 earnings report. They announced first quarter net income of $89.9 million, or $3.05 per diluted share, compared with $23.4 million, or 90 cents per diluted share in the first quarter of 2020. On an adjusted basis, their EBITDA rose to $181.3 million in the first quarter, compared to $121.2 million in the prior year period. Their adjusted net income grew to $72.2 million, or $2.45 per diluted share, compared with $29.9 million, or $1.15 per share in the prior year period. Covering the stock for Truist Financial is analyst Stephanie Benjamin. She writes that Atlas's diversified fleet and international reach favorably position the company to capitalize on increased air freight demand due to the global growth in e-commerce and ongoing supply chain disruptions. Furthermore, while Atlas was a clear COVID beneficiary, we believe its increased focus on long-term contracts over the last year has fundamentally strengthened its business model and should provide greater revenue and earnings visibility going forward. The Atlas Air stock comes in as a strong buy based on 4 current analyst ratings. Their average price target is $92, which would be a 22% growth. However, looking at our detailed list of ratings, one of those buy ratings is 3 months old and is now an actual downside, which is bringing that average down. If we look at the more recent ratings from the last 3 weeks, they range from 26% all the way up to a 44% growth potential that was just reiterated today. So there are our 3 growth stocks that analysts think might still be undervalued. I would love to hear your thoughts on these 3 companies, if they're stocks that you are already familiar with or maybe new to you, and what other undervalued growth stocks are catching your eye lately. So make sure to leave your thoughts in the comments down below. If you enjoyed today's video, make sure you hit that thumbs up button and that you're subscribed to the channel as well. Don't forget to tune in Monday through Friday for our pre-market morning update, where we have videos out before the opening bell, bringing you up to speed with everything you need to know. Thank you guys so much for watching, and we will see you back here next time.